Welcome to a special audio journey entitled The Symphony of Investment Masters. Have you ever wondered what separates a gambler in the financial markets from one of history's greatest investors? The answer isn't found in the numbers flashing across a stock ticker. It lies in something far deeper, an investment philosophy. The stock market is like a vast, unpredictable ocean, constantly stirred by powerful waves of greed and fear. To avoid being swept away, every legendary investor has built their own mental compass, a framework that guides every decision they make. In this audiobook, we'll explore four of the most influential schools of investing that have shaped the modern financial world. So, pull up a chair, put on your headphones, clear your mind, and let's begin our journey. Chapter 1: Value Investing. Price is what you pay. Value is what you get. In the short run, the market is a voting machine. In the long run, it is a weighing machine. In 1929, the Great Depression swept through Wall Street, wiping out fortunes and devastating millions of investors. Amid the financial ruins stood one man who had lost nearly 70% of his own wealth. Yet from that painful experience emerged an investment philosophy that would forever change the world of finance. His name was Benjamin Graham, the father of value investing. Graham's philosophy is perhaps best illustrated through one of the most famous fictional characters in investing history, Mr. Market. Imagine that the stock market is your business partner. The problem is, your partner suffers from severe mood swings. Some days, he's wildly optimistic. He believes every business is worth a fortune and eagerly offers absurdly high prices. On other days, he's consumed by fear. Panic clouds his judgment, and he's willing to sell valuable companies for next to nothing. The intelligent investor never allows Mr. Market's emotions to dictate their own decisions. Instead, they patiently exploit his irrational behavior whenever opportunity presents itself. To protect investors from inevitable mistakes and uncertainty, Graham introduced what would become one of the most important principles in investing: the margin of safety. The idea is simple. Only purchase a stock when its market price is significantly below its intrinsic value, ideally by 30 to 50%. That discount provides a cushion against errors in valuation, unforeseen events, and the unpredictable nature of financial markets. Graham was a devoted believer in objective, quantitative analysis. One of his most famous investment strategies was the net-net approach. Rather than chasing exciting stories or attempting to predict the future, Graham searched for companies whose entire market capitalization was actually lower than the value of their net current assets. In other words, he was buying businesses for less than the cash, inventory, and other liquid assets they already possessed. For Graham, investing was never about forecasting tomorrow. It was about maintaining rigorous discipline, trusting the numbers, and making rational decisions based on today's facts rather than tomorrow's hopes. If Benjamin Graham planted the seed, then his greatest student, Warren Buffett, the sage of Omaha, grew it into the mightiest tree the investment world has ever known. But Buffett didn't simply imitate his mentor. He evolved Graham's philosophy into something even more powerful. As Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." That single sentence marked a profound shift in investment thinking. Graham focused primarily on buying statistically cheap businesses. Buffett realized that the quality of a business could matter even more than the discount. At the center of his philosophy lies one of the most influential concepts in modern investing: the economic moat. Imagine a medieval castle protected by a deep, wide moat. The stronger the moat, the harder it is for competitors to attack. Buffett believed that exceptional businesses should possess the same kind of protection, a durable competitive advantage that competitors simply cannot replicate. Sometimes that moat comes from an iconic global brand, like Coca-Cola. Sometimes it comes from high switching costs, as with Microsoft, where customers become deeply integrated into an ecosystem that's difficult to leave. And sometimes it's created through powerful network effects, like Visa, where every new user makes the entire network more valuable for everyone else. These are businesses that don't merely survive. They become stronger as the years pass. Buffett also reminds investors of another timeless principle: the circle of competence. You don't need to understand every industry. You don't need to predict every technological breakthrough. And you certainly don't need to invest in every opportunity that comes your way. What truly matters is knowing exactly what you understand, and just as importantly, recognizing what you don't. When you stay within your circle of competence, your decisions become grounded in knowledge rather than speculation. And once you've found an outstanding business with a durable competitive advantage, your greatest ally becomes something no investor can ever purchase: time. Because over time, the world's most extraordinary financial force begins to work. Compound interest, often described as the eighth wonder of the world, compounding quietly transforms patience into extraordinary wealth. That's why, when Buffett is asked about his favorite holding period, his answer has remained beautifully simple: forever. Yet behind the extraordinary success of Berkshire Hathaway stood another brilliant mind. The man who spent decades challenging Buffett's assumptions, sharpening his reasoning, and helping him avoid costly mistakes. His lifelong business partner, Charlie Munger. If Buffett was the heart of Berkshire Hathaway, Munger was its razor-sharp intellect. Munger introduced investors to an entirely different framework for making decisions, a latticework of mental models. His belief was straightforward: if all you know is finance, you'll try to solve every problem with financial theory. If all you know is mathematics, you'll believe every answer can be found in equations. As Munger famously observed, to a man with only a hammer, every problem looks like a nail. Reality is far more complex. The best decisions rarely come from a single discipline. That's why Munger spent his lifetime studying ideas from physics, biology, psychology, engineering, economics, history, and many other fields. He believed true wisdom emerges when different disciplines intersect. Every mental model becomes another lens through which reality can be understood more clearly. One of Munger's most powerful thinking tools was inversion. Its logic is surprisingly simple. Instead of asking, "How can I succeed?" ask a different question: "How could I fail?" Then identify every possible cause of failure and systematically avoid each one. Rather than chasing success directly, you remove the obstacles that prevent it. Munger also warned investors about the countless psychological biases that quietly shape human decision-making. Confirmation bias, the tendency to seek evidence that supports what we already believe. Herd mentality, the instinct to follow the crowd simply because everyone else seems confident. Overconfidence, loss aversion. These invisible traps have destroyed far more wealth than market crashes ever have. To Munger, mastering your own psychology was every bit as important as mastering financial statements. Perhaps his greatest lesson is also his simplest. Successful investing is not about constant activity. And then, when a truly exceptional opportunity finally appeared, he acted with complete conviction, patient when nothing deserved action, decisive when everything aligned. Together, Benjamin Graham, Warren Buffett, and Charlie Munger built the foundation of what we now know as value investing. Their methods may differ, their emphasis may vary, but they all shared one enduring belief: the market exists to serve you, not to instruct you. Investing is not a game of prediction. It is a lifelong discipline built on rational thinking, patience, and the relentless pursuit of value. But while these legendary investors searched for exceptional businesses trading below, or at least reasonably close to, their true worth, another generation of investors began searching for something entirely different. Not undervalued companies, but businesses capable of growing tenfold, or even 100-fold. Chapter 2. Growth Investing. Leaving behind the world of mature value businesses, we now enter an investment philosophy fueled by innovation, ambition, and the promise of tomorrow. Welcome to the world of growth investing. Unlike value investors, growth investors aren't searching for companies that simply appear cheap. They're searching for businesses capable of becoming tomorrow's industry leaders. They aren't looking for bargains. They're looking for rockets waiting to launch. One of the greatest champions of this philosophy was Peter Lynch, the legendary manager of Fidelity's Magellan Fund. During his 13-year tenure, Lynch generated an astonishing average annual return of 29.2%, making him one of the most successful mutual fund managers in history. Yet despite those remarkable results, his philosophy remained surprisingly simple. Invest in what you know. At first, the advice sounds almost too simple to be useful. But behind those 4 words lies one of the greatest advantages individual investors possess. Peter Lynch believed ordinary people often notice great businesses long before Wall Street does. You don't need access to exclusive research. You don't need sophisticated financial models. Sometimes, your everyday experiences can reveal extraordinary investment opportunities. If your family can't stop talking about a new retail chain, if you notice customers lining up outside a restaurant every weekend, if a product suddenly becomes everyone's favorite, those observations may be telling you something long before analysts begin writing reports. To Lynch, the stock market wasn't hidden inside complicated spreadsheets. Sometimes, it was right in front of you. At the shopping mall, at the grocery store, in conversations with friends and family. The key is learning to observe what others overlook. But recognizing a promising business is only the beginning. The real challenge is identifying companies with the potential to become what Lynch famously called a 10-bagger, a stock capable of increasing tenfold in value. Finding just one genuine 10-bagger can dramatically change an investor's lifetime returns. That's why Lynch encouraged investors to remain endlessly curious. Observe the world. Ask questions. Do your homework. Because extraordinary companies often reveal themselves long before the headlines catch up. Alongside Peter Lynch stood another giant of growth investing, Philip Fisher. Widely regarded as the father of long-term growth investing, Fisher approached investing from an entirely different perspective. While many investors spent their days studying financial statements, Fisher believed numbers alone could never tell the whole story. He wanted to understand the business behind those numbers. To uncover that deeper truth, Fisher developed what became known as the scuttlebutt method. Instead of relying solely on annual reports and quarterly earnings, he gathered information from every possible source. He spoke with competitors, suppliers, customers, former employees, industry experts, anyone who could offer insight into how a company truly operated. His objective wasn't simply to evaluate a company's financial performance. He wanted to understand the quality of its leadership. Was management honest? Did they think long-term? Were they committed to continuous innovation? Did customers genuinely trust the company's products? Were employees proud to work there? And perhaps most importantly, was the company operating in a market with enormous room for future growth? Financial statements reveal what a company has achieved. Scuttlebutt helps reveal what a company is capable of becoming. For Fisher, outstanding leadership was never optional. He believed truly exceptional businesses shared 2 defining characteristics: an extraordinary management team and a massive market opportunity. Only when both were present would he consider making an investment. And once he found such a company, he had almost no desire to sell it. When asked about the best time to sell an exceptional stock, Fisher's answer became legendary. Almost never. Because great companies don't simply generate profits. They continue creating value year after year, decade after decade. Although Peter Lynch and Philip Fisher followed different research methods, they shared one powerful conviction. The biggest winners in the stock market rarely look extraordinary in the beginning. They often appear too small, too unfamiliar, or simply too different from the companies everyone else is paying attention to. The greatest opportunities usually hide where few investors are willing to look. Recognizing them requires curiosity, independent thinking, thorough research, and above all, patience. Because behind every global giant, there was once a young company that almost nobody noticed. Growth investing teaches us to look beyond what a business is today and imagine what it could become tomorrow. But while growth investors focused on discovering extraordinary companies before the rest of the market, another group of investors chose to step even farther back. Instead of studying individual businesses, They studied entire economies, interest rates, inflation, currencies, central banks, politics, global capital flows. Chapter 3. Macro Investing. Now, let's widen our perspective. Instead of focusing on individual companies, we turn our attention to the forces that move entire economies. This is the world of macro investing. Macro investors don't spend most of their time analyzing a company's balance sheet or quarterly earnings. Instead, they study the powerful currents that shape the global financial system. Interest rates, inflation, monetary policy, geopolitical events, currencies, debt cycles. To them, every nation is part of one interconnected economic network, where a single decision by a central bank or a major geopolitical event can ripple across markets around the world. When discussing macro investing, one name stands above all others: George Soros. In 1992, Soros made financial history. During what became known as Black Wednesday, he earned nearly $1 billion in a single day by betting against the British pound, a trade so legendary that it earned him the title, the man who broke the Bank of England. But Soros wasn't simply making an enormous wager. He was acting on a fundamentally different understanding of how financial markets work, a theory he called reflexivity. Traditional economic theory assumes that markets eventually move toward equilibrium. Soros challenged that assumption. He argued that human beings are never perfectly rational. Our perceptions are incomplete. Our judgments are often biased. And those flawed perceptions don't merely reflect reality. They actively shape it. When enough investors believe an asset will continue rising, they buy more of it. That increased demand pushes prices even higher. Those higher prices strengthen investors' confidence, which attracts even more buyers. Optimism fuels rising prices. Rising prices fuel even greater optimism. A powerful feedback loop begins to form. Eventually, a financial bubble emerges. But no bubble can expand forever. Sooner or later, reality catches up. Expectations begin to crack. Confidence disappears. Selling accelerates. Fear replaces greed. And the very same feedback loop that once drove prices upward now pulls them down with astonishing speed. This is the essence of reflexivity. Markets don't simply respond to reality. They help create it. Soros never searched for stability. He searched for extremes. Moments when market psychology had drifted furthest away from economic reality. And when he recognized that the tide was about to turn, he wasn't afraid to commit enormous amounts of capital. His willingness to act decisively became one of his defining characteristics. Yet despite his legendary confidence, Soros remained remarkably humble about one thing. He never believed that successful investors had to be right all the time. As he once said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." For Soros, investing wasn't about predicting the future with perfect accuracy. It was about managing risk, recognizing asymmetrical opportunities, and having the courage to act when the odds were overwhelmingly in your favor. If George Soros demonstrated the power of understanding market psychology, then Ray Dalio showed the power of understanding economic systems. As the founder of Bridgewater Associates, one of the world's largest hedge funds, Dalio views the global economy as a machine, an incredibly complex machine, but one whose movements are governed by recurring patterns and long-term cycles. According to Dalio, economies move through both short-term debt cycles and long-term debt cycles. Credit expands. Borrowing increases. Economic growth accelerates. Eventually, debt reaches unsustainable levels. Growth slows. Deleveraging begins. And a new cycle starts all over again. Understanding these cycles, Dalio believes, is essential for making sound investment decisions. But he also recognizes how difficult it is to predict exactly when the next economic shift will occur. Rather than trying to forecast every turning point, Dalio asked a different question. What if an investment portfolio could withstand almost any economic environment? That question led to one of his most influential ideas, the all-weather portfolio. Just as nature moves through 4 seasons, The economy moves through different environments. Periods of rapid growth, recessions, high inflation, deflation. No single asset performs well under every condition. Stocks often thrive during economic expansion. Long-term government bonds tend to perform well during periods of slowing growth. Gold has historically served as a hedge against inflation and monetary uncertainty. Commodities often benefit when prices across the broader economy are rising. Instead of trying to predict which environment comes next, Dalio believed investors should prepare for all of them. By carefully allocating capital among stocks, long-term bonds, gold, and commodities, an investor can build a portfolio capable of remaining resilient through changing economic conditions. To Dalio, this wasn't simply diversification. It was intelligent diversification. True diversification isn't measured by the number of investments you own. It's measured by how differently those investments behave when the economy changes. When one asset struggles, another may prosper. The objective isn't to eliminate risk. That's impossible. The objective is to reduce unnecessary risk while preserving strong long-term returns. Dalio has often referred to diversification as the closest thing investors will ever find to a holy grail. Not because it guarantees extraordinary profits, but because it dramatically improves the relationship between risk and reward. Although George Soros and Ray Dalio approach investing in very different ways, both remind us of an important truth. Financial markets don't exist in isolation. Every investment is influenced by forces far greater than any individual company. One investor studies human psychology. The other studies economic machinery. One seeks moments of extreme market emotion. The other prepares systematically for every economic scenario. Different philosophies, different methods, yet both pursue the same ultimate objective: to understand what drives the world before the rest of the market does. But beyond value investing, beyond growth investing, and even beyond macro investing, a new revolution quietly emerged. A revolution driven not by instinct, not by emotion, not even by economic forecasts, but by mathematics, algorithms, and the limitless power of data. Chapter 4. Quantitative Investing. Welcome to the final investment philosophy in our journey, a place where traditional investing begins to take on an entirely new form. Here, financial statements, management interviews, and even macroeconomic forecasts are no longer the primary source of investment decisions. Instead, the spotlight shifts to mathematics, algorithms, and data. Welcome to the world of quantitative investing. Leading this revolution is one of the most remarkable minds in financial history, Jim Simons, a mathematician, a codebreaker, a scientist, and the founder of Renaissance Technologies. For more than 3 decades, Simons' legendary medallion fund produced an average annual return of nearly 66% before fees, a performance many regard as one of the greatest investment records ever achieved. So what was his secret? Surprisingly, it wasn't a team of Wall Street veterans. In fact, Jim Simons deliberately avoided hiring traditional financial analysts. Instead, he assembled a team of physicists, mathematicians, computer scientists, cryptographers, statisticians, people trained to recognize patterns rather than tell stories. As Simons famously explained, "We don't predict the future. We look for patterns." That simple statement captures the very essence of quantitative investing. Instead of asking why a stock should rise, a quantitative investor asks whether historical data suggests that it probably will. The focus isn't on opinions. It's on probabilities. Every day, financial markets generate billions of pieces of information: prices, trading volume, volatility, interest rates, currency movements, economic releases, news events. No human mind can process all of that information, but computers can. Every day, Renaissance Technologies supercomputers analyzed billions of data points, searching for tiny statistical anomalies that might exist for only a few seconds or even a few minutes. Minute pricing inefficiencies, recurring market patterns, temporary imbalances. Individually, these opportunities were almost insignificant. But when identified and exploited millions of times through fully automated trading systems, they became an extraordinary source of long-term returns. Once an opportunity appeared, the algorithms took over. They determined when to buy, when to sell, how much capital to allocate, when to cut losses, and when to lock in profits. Every decision followed strict mathematical rules. Human emotion had no place in the process. No fear, no greed, no hesitation, no overconfidence. The psychological biases that often undermine individual investors were removed almost entirely. For Simons, consistency mattered more than intuition. The system didn't care about opinions. It cared about evidence. If the data supported a trade, the trade was executed. If the data changed, the position changed. No ego, no attachment, only probabilities. In many ways, quantitative investing represents a new chapter in the evolution of financial markets. For centuries, investing relied almost entirely on human judgment. Then came computers, then algorithms. Today, artificial intelligence and machine learning are pushing the boundaries even further. Modern investment firms analyze satellite imagery, consumer spending behavior, supply chain data, natural language processing, alternative data sources that were unimaginable just a few decades ago. The financial markets have become a battlefield where algorithms compete against algorithms, and data competes against data. Yet despite all this technological progress, one timeless truth remains. Every model is designed by people. Every algorithm is built upon assumptions, and every statistical relationship can eventually change. Markets evolve, technology evolves, human behavior evolves. The most successful investors understand that no model is perfect. Even in the age of artificial intelligence, adaptability remains essential. Jim Simons demonstrated that extraordinary investment success doesn't always come from making better predictions. Sometimes, it comes from building better systems, asking better questions, and trusting evidence more than emotion. With quantitative investing, we arrive at the newest frontier in finance, where mathematics meets economics, computer science meets investing, and data becomes one of the world's most valuable assets. Yet after exploring every major investment philosophy, one question still remains. Which path is right for you? The answer lies not in copying a legend, but in... And so, we've reached the end of our journey. Together, we've explored the minds of some of the greatest investors in history, individuals whose ideas have shaped not only the financial markets, but also the way millions of people think about risk, opportunity, and long-term wealth. We've discovered Benjamin Graham's unwavering commitment to the margin of safety, where discipline always triumphs over speculation. We've followed Warren Buffett, who showed us that extraordinary businesses, protected by enduring economic moats, can reward patient investors for decades. We've learned from Charlie Munger, whose latticework of mental models reminds us that wisdom comes from connecting knowledge across many different disciplines. We stepped into the world of Peter Lynch, who encouraged ordinary investors to find remarkable opportunities hidden within everyday life. We learned from Philip Fisher, whose scuttlebutt method revealed that understanding people, leadership, and corporate culture can be just as important as understanding financial statements. We witnessed George Soros challenge conventional economic thinking through the theory of reflexivity, demonstrating how human psychology can reshape financial reality itself. We explored Ray Dalio's systematic understanding of debt cycles and diversification, showing us that preparation often matters more than prediction. And finally, we entered the data-driven world of Jim Simons, where mathematics, algorithms, and artificial intelligence continue to redefine the future of investing. Looking back, one truth becomes unmistakably clear. There is no perfect investment philosophy. No single strategy guarantees success, and there is no universal roadmap to becoming a great investor. What truly matters isn't choosing the philosophy that worked for someone else. It's discovering the philosophy that best fits your personality, your knowledge, your temperament, your financial goals, your tolerance for risk, The greatest investors in history didn't become legends by copying one another. They became legends because they remained remarkably consistent with their own principles. As you continue your own investment journey, remember this. Markets will rise. Markets will fall. Economic cycles will come and go. New technologies will reshape the financial world. But timeless principles never lose their value. Stay curious. Keep learning. Think independently. Manage risk with discipline. And never allow emotion to overpower reason. Because successful investing isn't about finding the perfect stock. It's about becoming the kind of investor who consistently makes thoughtful, rational decisions over a lifetime. Thank you for joining us on this audiobook journey. I hope these timeless philosophies have given you not only a deeper understanding of investing, but also a broader perspective on patience, discipline, and long-term thinking. I wish you wisdom in every investment decision, confidence through every market cycle, and steady progress on your own path toward financial freedom. Until next time, take care and happy investing. In our upcoming episodes, we'll dive much deeper into each investment philosophy we've introduced today. We'll explore their core principles, practical strategies, real-world case studies, and the lessons they offer for investors at every level. If you'd like to continue learning with us, be sure to stay tuned for the next chapter in this series. If you enjoyed this audiobook, please consider liking the video, subscribing to the channel, and leaving a comment below. Your support helps us continue creating thoughtful, in-depth content for investors and lifelong learners around the world. Thank you so much for listening. We'll see you again in the next journey.